It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and believe it or not, we only have a very short period of time in 2012 to effect some positive changes on your tax return, and we want to help you. We're from EG Tax, and we're going to talk about a lot of things in this half hour that'll help you to get ready for this year and for next year. And if you have any questions, we'd love to talk to you. 803-0930, 803-0930, star 930 on a cell phone. And as always, I got my faithful crew here. I got Chris Fabian. Hey, Christopher.
Hello.
Wow,
Well, did you get your Christmas
I'm looking
shopping
at him.
done?
He's got glasses on.
I got my glasses on right now. Yes,
And you got your Christmas shopping done,
our
Chris?
Christmas shopping is done.
Attaboy. You probably didn't do any. I bet you Tiffany did it for
No,
you, right?
we spent a ton of money on my mother-in-law.
He did not do any Christmas shopping. It was all me,
So
as
that's
usual.
Tiffany Fabian, who is my right-hand gal and
Merry
Christopher's
Christmas.
wife. And then we got Stevie there, Steve Jacobson. Hey, Steve.
Hey, Esther, how's it going?
Good. Okay, so let's talk about some things that people are going to be interested in, because as of right now, the fiscal cliff is absolutely a possibility, right?
Right.
Absolutely.
I heard they might add that word to the dictionary, fiscal cliff.
Fiscal cliff. All right, so first of all, one of the potential problems is the AMT problem. Now, what is the news reporting?
News is
Regarding
reporting.
the AMT
News
patch,
is
if it
reporting
doesn't come
that really nothing has happened with anything with negotiations, according to Fox News, which I saw a little while ago. Republicans have kind of sent it over to the Democrats at this point and said, "We're not doing anything at this point.
And
you guys figure it out."
Because of that could hold back e-filing and
Yep.
getting.
That's exactly right. They're talking about that two-thirds of the population may not be able to file till March. So
But I mean, you could get your returns started.
So that's what we're going to do. In the event that the AMT patch doesn't come through, and by the way, that could mean an additional $7,800 in additional taxes to somebody whose income is over this threshold of $45,000. So let's pray to God that this patch comes through. It has every year, but right now it's being held hostage between the Democrats and the Republicans, and it's a negotiating standpoint. But it could be an additional $7,800 in taxes, and it could hold up the filing of returns till March. Now, what we'll do is we'll get the returns ready to go, and as soon as the patch comes through to the IRS, boom, we'll send them off. So I just want you to know that EG Tax is on top of everything, but that's one of the potential problems.
Yeah.
And one of the things we wanted to make sure people understand, how about RMDs that have to be done?
Right? You have 1 week left to take out your required minimum distribution if you're over 70 and a half. And, if you say, oops, I forgot, you're looking a 50% penalty.
So if you were
Of the
supposed
amount.
to take $10,000 out of your pension and IRAs once you're age 70 and a half and you don't do it, the penalty is $5,000.
That's right. A
Right?
ton of money.
That's
A lot
right.
of money.
That's right.
Another thing is, before December 31st, if you got your gainers, your stocks that are at a gain, why should people think about getting rid of those stocks right now?
Get rid of them now before the capital gains rates go up if the fiscal cliff goes off, if we go over the fiscal cliff. Because if you do it now, you're either going to pay zero if you're in the 15% bracket or lower, or maximum tax rate of 15%. Right.
Right. So you would save at least, if you're in the 15% bracket or lower, you would save 20% on capital gains. So that's something, I know nobody wants to think about it that right now because it's the Christmas season, but you really need to think about it, because if you have potentially, let's say, $100,000 in gains, you could save $20,000 in taxes if you're in the 15% bracket. So that's something you want to think about, because if after January the 1st, and if the fiscal cliff happens and the capital gains rates go up, you'll end up owing that money in 2013. The other thing is 529 plans. Who qualifies for 529s, and why is it a good thing to contribute to it before December 31st?
Anybody who pays New York State tax files, can put into a New York 529, and you'll be able to have a nice deduction on New York State.
So what is a 529, Chris?
529 is for education, and if you're a single taxpayer, you can put up to $5,000 into a 529, and if you're married filing joint, you can put up to $10,000. And so it's a credit to you, and so the money you can use it to pay for college for you or your dependents.
And let's face it, if you're in the 8% tax bracket on New York State and you put $10,000 away in a 529, it saves you $800, right?
Yep. Or if you have if you're a grandparent and you have a granddaughter or grandson, you don't know what to get them. I mean, you can take advantage of the gift exclusion and put in up to $60,000 in 1 year for them away.
That's exactly right. Okay, I know we got people that are holding. I think let's start off with Greg in Strikersville. Hey, Greg, how can I help you? How can we help you?
Go ahead, Greg.
Full-time. Hello?
Hey, Greg.
Yeah, hello. My son's a full-time student this year, and this is the first year he's taken out a subsidized loan. Is this deductible, and if so, when is it?
Okay,
when he actually pays
Steve,
it off,
why don't you tell him about the subsidized loans?
Well, what you're going to do is when you actually start making payment on those loans, that's when you would actually deduct it at that point. Is when
But
He can take the education credit right now.
You took out a loan, and effectively the loan paid for the education, you're still going to qualify for
the education
in the
credits.
first 4 years of continuing education.
For the American
you're going to
Opportunity
qualify
Credit.
for the American Opportunity Tax Credit, right?
So it's good news for Greg and his child.
Right. So even though you borrowed the money, you could save up to $2,500 on your federal return and another up to $500 on New York State. So you could save $3,000 off of borrowed money. So that's a good thing. The unfortunate thing is this is the last year for the American Opportunity Tax Credit unless they do something here in the next week.
Okay, this is his last year of college, though, too. So.
And Greg, for a little bit of
hallelujah for that, hey?
And Greg, for a little bit of future planning, depending on what happens with the fiscal cliff, he may or may not be only able to write off the first 5 years of his student loan payments for the interest that he would write off. So if we go over the cliff, he only gets the first 5 years.
But at least he is in that would be the first 5 years of education, so that would still be deductible to him.
Yep.
Oh, okay. Well, he's got a small amount, so it isn't. He should be able to pay it off in a few years.
Oh, that's great. That's great.
All right.
Well, thank you.
very
Merry
much.
Christmas.
Oh, same to you.
All right, thank you. I'm Esther Gulius, the tax lady from EG Tax. If you want to join us here with any tax questions, if you're worried about the fiscal cliff, if you're worrying about what you can do in the next week to save taxes, give us a call in studio, 8030930, 8030930, star 930 on a cell phone. And I know we have people holding, but let's go back to some of the other things people can look at before the year end. Now, a new thing that's going to come up if the taxes go up is tax planning. People really almost haven't had the tax plan the last 10 years because the tax rates were so darn low. Now, with the tax rates going up, tax planning is going to become very important because the only way that you're going to save money in taxes is to sometimes create a tax shelter. So that's something that EG Tax does. And what do we charge people for that?
Absolutely nothing.
Hallelujah. We don't charge anything. So you just come on in, and we'll be very happy to tax plan with you so that you can save as much money in taxes as you possibly can. I was just talking to somebody about a half hour ago about many people that in the past haven't wanted to maybe start a small business or something. They had no incentive to do it. Now may want to start a small business because that startup costs are going to be deductible, and that'll reduce their overall tax liability. Then ultimately, at some point in time when it's making more money, then they want to do it again. So that happens many times with when tax rates go up, people start looking for tax shelters, right?
Absolutely. Yep.
Okay,
absolutely.
Let's go back to the phones, and we'll talk to Joe in Eden.
Hi,
hey, Joe, how can I help you?
Hi. I got a nephew that just started working in New York City. What should we advise him to make sure he makes a minimum contribution to his IRA for $500 or something? You guys on the show a couple weeks ago, your guys, and they were saying, yeah, definitely at least get in for at least $500 because they match or something? Am I confused?
Well,
Well,
there's all kinds of things. First of all, because he's in New York City, he's paying federal, state, and city taxes. So that poor puppy is going to be hit more than the rest of us. So he has very substantial tax problems. Now, obviously, the more money that he can have sheltered, the better he's going to be. So,
Right.
so I think that maybe Steve was talking about a couple weeks ago the benefit, of course, of putting money into your 401k plan, because many times your employer matches that pre-tax, right?
Right.
So
Right,
that would
I
be a
understand
good
that.
thing. So that would be a good thing. Buying a piece of property that he could live in would be a good thing. If he could afford, because I know New York State is New York City is a very expensive place to live. But if he could get a mortgage on a place, the interest and property taxes would be deductible. Obviously, is he somebody that is a professional person and he has expenses?
Because I'm
for his
thinking the
job?
moving credit too. The moving credit, if he moved there for a job.
Right,
Yeah,
and if he moved to New York City for a job, that would be deductible.
I'm sure they advise him like that. He's a young engineer.
Was this his first job, or has he been an engineer at some?
It is his first job.
Okay, so Chris, you want to explain that?
Yeah, I mean, with moving, you'd have to move for your job or similar
Right.
job. So unfortunately, with
For
the
the
moving
first job, it
expense,
won't.
So he wouldn't be able to take it because he didn't already have a job.
right?
But Chris, I was wondering because he was only a New York City resident for part of the year, so he'll just have to do
part of the
year in New York City.
So anyway, your nephew is going to pay the most taxes possible. His New York state and city taxes will be an itemized deduction. So make sure if he's a single guy, because the standard deduction is only $5,000, he definitely wants to look at itemizing.
He's gone.
We lost him.
Okay. We
So-
lost his nephew, or we lost
We lost the call.
Bye, Joe. Merry
Joe and his
Christmas.
nephew. All right, I'm Esther Gullius, the tax lady. Our phone number here in studio is 803-0930, 803-0930, star 930 on a cell phone. And if you would like to become part of the conversation, ask any tax questions. Tax season is really only officially, 10 days away? 9 days away. So once that December 31st deadline happens, that year closes, and then we're looking at a brand new tax year with brand new taxes and tax laws. And of course, part of what we do is at EG Tax, when you listen to Ask the Tax Lady, we will keep you abreast of all the upcoming tax changes, and we will make it so that you understand how it affects your tax situation, right?
Absolutely. Yep, that's correct.
Okay, another change that's happening is capital gains and dividend rates. What does that mean to the average person?
Well, right now you have ordinary dividends and qualified dividends, where the qualified dividends get taxed as capital gains, so you pay a reduced tax on them. Well, if we jump over the cliff, then unfortunately there's no such thing as qualified dividends anymore, so all dividends will be taxed as ordinary income, so that could mean a major tax increase for a lot of people out there.
Right, so if you're somebody that gets dividends, you want to take a look at that in a tax planning situation so you understand that.
Right.
How about if you're self-employed right now? What could somebody do before year end to reduce their tax liability?
Self-employed people might want to buy larger assets or to take advantage of depreciation because depreciation is going to be changing. I know Section 179, if we do go over the cliff, Section 179 is going to drop to $25,000. So you might want to take advantage of depreciation, and bonus depreciation is completely going to be gone. So you definitely want to look at these things.
You look at your business and you say, gee, I really am going to need more computers. I'm going to need a new printer. And this is something that you're going to need in the short term. You might want to this week go out and buy those assets in 2012 because, as Tiffany says, the 179 expensing is going to drop down to $25,000. And if you need $40,000 or $50,000 worth of things, now you can take it in 2012. In 2013, you won't be able to do that. Now, and when you couple that with your FICA and that you are going to save this year, that's a great big tax savings.
Right. Because the FICA, the holiday is gone.
Yeah, but it's currently
So,
5.65,
right.
and it's going to go to 7.65.
Now, who does that affect, Chris? So on January the 1st, the FICA honeymoon, who does that affect?
Well, that affects everybody who has earned income, whether it's wages or self-employment.
So if you are making $1,000 a week,
Yep.
how much will your paycheck change?
$20.
$20 for sure.
Yep, 2%.
And that's because that's gone. The FICA honeymoon is gone.
Yep.
Other things, IRAs. We were talking with that gentleman about his nephew putting money in an IRA. Who should look at IRA contributions?
Anybody who doesn't have a qualified plan, or if you do have a qualified plan, if your income's low enough, you may still be eligible to put one in.
And I think that's a big deal, too, because a lot of people have that misconception of, well, my wife doesn't work, so she can't put into one. Well, if you're working, you could put in for a non-working spouse.
Right, because that's a spousal IRA.
And,
right?
and if you're a self-employed person, you can also put money into your pension plan, too.
Yeah.
Yep.
Okay, now it's Christmas time, and everybody's thinking about what to give everybody as a gift. How about gifting of cash?
Absolutely, up to $13,000 without having to file a gift tax return. But it's also a big deal for those who have high estates to start gifting money away, because if we go over the cliff, the fiscal cliff, the estate exclusion is going to drop from $5.12 million of exclusions to around $1 million there.
Right. So, and so what you might want to consider doing is gifting as much as you can this year, which is a great Christmas gift. Everybody's in line for that $13,000. But actually, you can gift over that, and you don't. And all you have to do is do a gift tax return.
Correct.
But it won't cost you anything to do that, as far as income taxes. Correct?
Right. That's right.
That's right.
It's like a
Gift taxes,
bookkeeping
right.
process.
But the other thing is, people that are giving, like, let's say mom has a house that she's thinking about going into a nursing home, so she's thinking of giving her children her house. That could be completely looked at differently in 2013 going forward, right?
Absolutely.
You guys, in other words, now if she gives the house, the maximum you can pay is 15%. But in the future,
right.
you will pay 20% on that gift.
But I think I think that's such a big thing, though, Esther, too, because if you do plan on gifting the house, especially for those life estates and things like that, to do a gift tax return for that, because then you have to figure out what mom's basis in that house was. So when it comes to them selling that house down the road, it'll be a lot easier for them to figure out. Otherwise, you're going to be sitting there and you won't know what mom bought or what mom put into the house over the years, and that could be a real issue for especially down the road with those higher capital gain rates.
And especially if the gift that mom gives you, let's say her house is worth $200,000. Well, you not only are going to pay the cap gains tax on it, but you also could pay that new surcharge of 3.8%.
Oh, yeah.
Right?
Yep.
Absolutely.
So it ends up being maybe almost 24%, and the state of New York, which is 8%. So now you're looking at 32% off of a gift of a house. So be very careful before somebody transfers over the deed on an asset, because it will cost you money upon the sale as opposed to inheriting it, right?
That's right.
So if they inherit the house, what happens to their taxes in that situation?
Well, then they get their new stepped-up basis. So then they get the fair market value upon date of death. So let's say when mom died, it was worth $190,000, and you're now selling it for $195,000. You only have a gain of $5,000, whereas opposed to, let's say you're trying to figure out that basis as a gift, and let's say you only figure out $100,000. Well, now you got to pay $95,000 in capital gains. I mean, it's a big difference.
That's right. And so. And again, with the capital gains rates going up, that is a serious thing.
Absolutely.
And then, of course, another change this year: sales taxes are no longer deductible as an itemized deduction.
Right.
No more writing off a new car.
Right, which was really nice, I think, for seniors and people who didn't have a lot of wages. It was a really good opportunity to deduct your sales tax, and then big ticket items like cars, you could also add that to it and make your sales tax write-off that much larger.
But again, that's one of those changes. Then the other thing is the earned income credit is going to be much more difficult this year, because you have to prove that the child lived in the house. Is that correct?
Yep, this isn't even a Cliff thing. This is the IRS change. They want proof that your child is your child before they give you a handout.
Yeah, the earned income credit is now 4 pages
The
long.
EIC disclosure is now 4 pages long, and
Right.
And if you're self-employed too and get EIC, you have to prove that you're a true business. And heaven forbid, people make one up just for tax purposes.
Yeah, this is a
Right.
high
and
area
so
fraud.
but the IRS is getting very strict on earned income credits because basically they can give you with the state of New York, $8,000 back on money you didn't pay in. So they are tightening up that, and so you want to make sure that when you're doing your taxes this year, you're ready to prove to your accountant that you qualify, that you have a qualified child living in your house, right? And that really goes back to all of the new licensing requirements for tax professionals, because they have to have 15 hours of continuing education in order to get their PTIN, right?
Right,
And
absolutely.
so you want to make sure that you're going to a qualified tax professional to make sure that you're with somebody who's following IRS guidelines.
And anybody who
Because-
has a PTIN has to take the IRS test by the end of 2013. And so they not only have to get their qualifying education in, but they also have to take that mandated test now, too.
Well, let's go back to the phones. We have Chris in West Seneca holding. Hey, Chris, how can I help you?
Hey, Esther. Question I've been kind of wanting to ask the last couple of weeks. I haven't got a chance. I just got home from work, so I could call you now. I know about the AMT. You're talking about that and the fiscal cliff and the dividends. I'm in a situation where I'm in the bottom income tax bracket. So I was looking to, take advantage of the no capital gains, federal tax on my capital gains. But if that puts me over $45,000, is that, I'm married. Married with family. Is that going to bump me into the AMT bracket then? Trap.
Depends on how much.
I mean,
depends on
that's
how
part
much.
of, you should never base your tax planning on a radio show host that just talked to you for 3 minutes.
Oh, I know, I understand that.
What you really need to do, this would be my suggestion, it is possible that it could put you into an AMT situation because the gain is a tax preference. But what I'd suggest you do is call us right after Christmas on Wednesday or Thursday or Friday next week, and we can give you exactly how much you can do, and
he
to
doesn't
make
have
sure
much
that
time
you're
left.
under the AMT amount. Now, I do think that they're going to, I hope, put it back to $75,000 where it should be for a married couple, and then you would have no problem at all. But
Right,
that would
and
be
if that
kind
was,
of
it would be a problem. And what
crapshoot
my
for you.
understanding was, because it would put me over to 45 for sure, and I
Right.
understand, obviously. And you were a tremendous help last year, your office. I went out there, and they helped me do the same thing last year. But I could sell it on Wednesday and buy it back again on Thursday.
There you
Because I'm
go.
not-
Smart
I'm sorry?
man.
Yep.
Smart
And I'm
man.
not looking to write a gain. I mean, to write a loss off.
Right.
I gotcha. That's cool.
All right, well, I'll give you a call. You have a great Christmas, everybody there.
You
Thank
too.
All right,
you,
thank you
Chris.
very much,
Merry
Chris.
Christmas.
Merry
Thanks.
Christmas. Okay, and then Tiff, you were, we only got 5 minutes left in the show. So you were telling me about the IRS is doing kind of a lot more stopping over to see people.
Yeah,
right?
I was talking to Steve Jacobson about this. I had 2 clients, and the IRS actually went to their house unannounced and did visits. And Steve said no, that had to be New York State. And no,
Yeah,
sure enough,
Every one of them that I've ever dealt with has always been New York, so that's different.
no,
I
they
mean.
brought in the business cards. It was the IRS.
Well, now remember, the IRS, the administrative arm of the IRS for Obamacare, for the federal government for the Obamacare, is going to be the IRS. So there's going to be a lot more agents that are being hired.
Yeah.
Yep.
But so those weren't taxes we did, but those are people that the IRS stopped at their house and then they came to see us.
Right, and then they came to see us, and one of them had owed taxes for a number of years, and another firm they were using another firm, and Chris had told me that they had to give lots of notice and notification
They
and
did.
warnings.
All the statutory limitations.
Yes, and so. But then they finally approached her, went to her house, and this other gentleman he just came to me a few days ago. The IRS agent came to his house. We had filed all the taxes, and we were doing.
Yeah, he was going to appeals,
Appeals.
and apparently this collection person never got the notice that he was going to appeals, and
yeah.
so
She said it wasn't
but
coded in the
the
system.
bottom line for everybody listening is if an IRS agent shows up at your door, you can say, I need to talk to my accountant.
Don't
and
ignore
even
it.
if EG Tax didn't do your return, you call us because we'll be there to help.
Absolutely.
And we do not charge to do audits.
No, we did a
So
9/11
Auntie
for
Esther
this
and
guy.
the crew here, we're in your corner.
Yeah,
Okay.
yeah.
A couple other things. We got a couple other calls here. Let's go quickly to Julie from Blaisdell. Hey, Julie.
Hi. I have a question. My daughter is 23 years old. This year she's making about $12,000, and she wants to open up an IRA. Is it better for her to open a traditional or a Roth?
Okay, I'm going to tell you. Because of her age and because of her tax liability, she can, if she puts money into a Roth, none of the money is going to be taxable when she takes it out, and actually she never has to take it out. But she doesn't get a tax benefit for it. But if she puts money into a traditional, she gets the tax write-off now, and then when she takes it out, it's going to be taxable. I think many people, conventional wisdom, when somebody's this young and in this tax bracket, it just may be better for her to do the Roth this year because it doesn't really affect her tax liability because she's in a very low tax bracket. So I think for this person, I'd suggest a Roth.
And is she dependent on your return anymore, or is she no longer dependent on your return, Julie?
No, she's not anymore.
Okay, so, yep, Esther's right. Very low tax bracket.
Okay, so it's so low, it's not going to hurt her any. Now, if she were in the 45% bracket, then it would be a lot of money to be giving up. So, and that's when you really have to put a pencil to the deduction and say, this is good, this is bad, and you make a decision. But in her situation, she's in the 10% tax bracket, so it's not that much money. I guess I'd look at doing a Roth. You can always do a Roth and a traditional and keep them both going, one and then the other, depending upon 1 year it might be better to do a traditional, 1 year it might be better to do a Roth.
And with the Roth, she would still qualify for the retirement savings credit, so that would wipe out her liability with her income. So,
right. Anyway, I hope all of you, all of our clients, all the people that listen to our radio show every week, I hope you have a wonderful Christmas time. I hope you have a great time with your family. I know for myself and my staff, I can tell you we're very blessed to do this show, and we're very blessed that you guys listen to us. We are very thankful for Western New York and all the Western New York people. And so until next week, and I hope you have a great Christmas season. And you can send me presents anytime you want. No, I'm kidding. Until next week, I'm Esther Golias, the Tax Lady, with Chris Fabian, Tiffany Fabian, and Steve Jacobson. Have a great Christmas and a great week. Bye-bye.